you want to be focused on this breakout from prior highs. And when you come off those other periods and you break it with authority, of which gold has done a few years ago, you tend to see some monumental price changes. And I think that's going to be the...
You're watching Silver News Daily. Subscribe for more.
The $50 silver breakout is here, and almost nobody understands what it really means. For most investors, it's just another headline, another spike, another rally that'll come and go. But what if I told you this isn't a peak? It's a trigger. A technical confirmation decades in the making that could now unleash one of the most violent, wealth-redefining moves we've ever seen in the history of precious metals. Because this isn't some random chart pattern, it's a completed cup and handle formation that's been building since the 1980s. The same structure that triggered gold's breakout above $2,000 in 2023 and led to a 25% surge. But silver's version is even bigger, even deeper, and according to some of the top macro minds on the planet, we've only just entered the early innings of an explosive parabolic move. And here's what the mainstream still doesn't get. This isn't a bubble. It's the opposite. The price action we're seeing right now is the violent revaluation of an asset that has been suppressed, ignored, and grotesquely undervalued for decades. A full reset of what silver should be worth in a world of broken currencies, sovereign debt spirals, and runaway deficits. Now add in the fact that mining stocks are still priced like silver is under $20, and you're not looking at just another rally. You're looking at a setup for 10x gains in select names as the market scrambles to reprice decades of denial. This moment is more than historic. It's potentially life-changing. So how did we get here? And what exactly does this chart pattern mean for what comes next? Let's dive in.
Well, I think the catalyst is always gold, right? I mean, if you study history, and I know a lot of people have been talking about solar panels, and that just goes to show how off the track we've gone from the main thesis for silver, right? The main thesis for silver has nothing to do with that. That's great. That's just a add-on to the thesis, and it's certainly very complementary, but the real movement won't come from that. It will come from the fact that it's a monetary metal, that it's an inflationary asset that tends to perform very well when we're in a gold cycle. And I think gold has signaled that we are in a cycle. Maybe it started a while back, and I think it's just, I would say a few years back, and it's been confirmed. And the next one to see the same situation is silver. And in conjunction with that, we should see the mining companies also do the same. And so, because they carry similar levels of risk, obviously one is operational, the other one is volatile, just given the fact of the nature of the asset relative to gold and the size of the market. But these two things just, I know a lot of people are looking at a 6-month, 1-year chart of these companies and these assets, but step back 30 years, 40 years, 50 years, what do you see? We haven't seen anything, right? I mean, it's just a blip, what we've seen so far. So it's just fascinating that people are just so concerned that, we've seen enough, this is a bubble. And I was at Beaver Creek during the conference for precious metals. And the question I got the most is, are things too frothy? What? We haven't seen anything yet. I hope I'll tell people when it's too frothy, and that will be my goal. But look, we haven't seen anything yet. I mean, this is just, it's great. It's confirmation. There's no doubt all these things look overbought here near term. Would I get in front of that overbought signal? No, that's not what I do for a living. I invest on things that are secularly changing. And if you are of that type of mentality, you don't trade things in and out like this. This is just nuts. I'm not that smart to do that, and I don't think anybody is. And it's time to be building businesses in these trends and owning things that are high quality, and buckle up. It's going to be, in my view, a very fun next 5-10 years.
This isn't just a breakout. It's the final confirmation of a pattern that's been unfolding for over 40 years. Silver's cup and handle formation, one of the most reliable technical setups in the market, has finally completed. And now, with spot prices bursting through $45 and tapping $46.71, the chart isn't just bullish, it's screaming. This isn't some short-term noise on a daily chart. We're talking about a structure visible on the quarterly and annual timeframes, stretching all the way back to the 1980s, and now signaling a measured move toward $90, potentially even $100. This is the same setup gold followed in 2023 before it exploded to new highs. Back then, gold's breakout was met with skepticism, but it ended up being the launchpad for a 25% gain in just 1 year. And now silver is repeating that same behavior, but on steroids. In September 2025 alone, silver surged nearly 15%, broke above its 2011 intraday high of $49.50, and confirmed its breakout with 20% above average trading volume. This is not retail FOMO. This is serious institutional capital reacting to technical confirmation. And let's be clear, the cup and handle pattern doesn't just measure past price behavior. It projects future moves. Historically, when this structure breaks out, it leads to massive repricings as suppressed assets catch up to their true value. According to Investing Haven, we could hit $48 before the end of the year, and if the breakout holds, $88 before 2028. Even the most conservative estimates, like those from TD Securities, still expect $60 silver by 2026. But the real key is $50. That's not just a round number. It's the final psychological barrier. Once breached, it opens the floodgates. And now, with prices just a breath away, silver's setup is no longer potential. It's active. The move is underway. The question isn't whether this is real. The question is, are you positioned for what comes next? Because the data says this move has only just begun.
Well, usually, I mean, the tendency is that we're likely to see a major breakout on this, and those tend to be very explosive. We may see a little bit of a digestion at the 50 level, but I think, I wouldn't trade that. All I'm saying is it shouldn't shock anybody if we see that. And even if there's a sell-off in that period, you want to be focused on this eventual move that I think it's going to happen, which is a big breakout from prior highs, and we're going to make, we usually when you come off those other periods and you break it with authority, of which gold has done a few years ago, you tend to see some monumental types of price changes, and I think that's going to be the case here. And it's important to know that mining companies are still trading as if silver prices are much lower. Not only that, but if you consider the fact that they're still mining silver at sub $20 an ounce, every incremental dollar increase here in silver prices is a quite significant leverage for those companies to generate free cash flow. And and especially the ones that are being smart about the situation with energy and are being able to hedge energy costs here as we see this metal prices situation come to fruition.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
$50 isn't a finish line, it's a fuse. And when it ignites, the move that follows won't be gradual or orderly. It will be parabolic. This is what so many investors get wrong. They look at $50 as resistance, a wall silver can't break. But in technical terms, $50 is the point that confirms the start of a much larger measured move, one that targets $90, even $100. That's not fantasy, it's mathematics. It's what decades of chart structure have built toward, and we've now entered the acceleration phase. Think about this. The last 2 times silver approached $50 in 1980 and 2011. It was in the context of runaway inflation, collapsing dollar confidence, and geopolitical chaos. And both times, silver delivered explosive gains in compressed timeframes. In 1980, it shot from under $6 to $50 in months. In 2011, it rocketed from $9 to $49 in less than 3 years. And now, the macro picture is even more extreme. But unlike those two events, this time it's not just a speculative pop. It's a full-scale confirmation of a multi-decade technical base. Tavi Costa isn't mincing words. He calls this breakout explosive, pointing directly to the pattern's secular strength. What we're seeing isn't an overshoot. It's the early stages of a move that hasn't even begun to price in the true fundamental risks. With the dollar tumbling, debt to GDP soaring past 130%, and central banks rotating into hard assets, the old $50 ceiling is rapidly turning into a new floor. And this shift in perception is everything. Once $50 becomes support, not resistance, every model, every algorithm, every risk-adjusted portfolio has to reprice. That's when the real inflows begin. That's when volatility explodes. And that's when the silver market does what it always does in moments of crisis, goes vertical. So if you think $50 is the top, you're playing the wrong game. This isn't the end. It's the detonation point.
Yeah, I think the easiest way to understand a twin deficit issue is just like a normal company, and how that affects a company itself, right? If you're a company, you're bleeding cash every year, and when you bleed cash, you have two options. You have either dilute your equity or you just raise money on debt. The US government has decided to do this through debt. And so what you're seeing here is that basically the US government as a company, again, has two forms of revenues streams. They can either collect more taxes than what they spend, which we all know we have a spending problem, and so we're not collecting more than what we're spending. And so we have a deficit on the fiscal front. And the second way is when you're exporting more than you're importing. And I know that there has been enough people talking about this fiscal issue, but not enough people are talking about the trade problem, of which is almost as severe. And structurally, when you go back to all the way to the 1800s, this is one of the worst we've seen. And so when you look at that and you think about, all right, well, so we have a twin deficit issue. We also have debt at, basically all-time highs. So we're compounding that debt at a degree that we've never seen before. And on top of it all, we also have a very overvalued dollar relative to other fiat currencies. I mean, I think the easy trade that everyone is focusing on is on the hard assets, which I'm not moving away from that view. Like that's still happening. It's developing. What people are just maybe dismissing is the fact, can we see other fiat currencies actually appreciate versus the US dollar just because the US government cannot afford having such a strong US dollar? And that's probably going to be the case here. So I'm of the very strong view that we're seeing a sort of a digestion of a big move in the US dollar recently here. One of the largest declines of the DXY index since the 1970s. And I think as we see this digestion, the big question is, are we seeing a bounce of a major support or the potential for a big break of that support that will catalyze long-term decline of the dollar versus of other fiat currencies? I am of the latter view, and I think that that's going to be one of the most meaningful trends in the macro world. And as we see that being, formed at some point here, and I think it's going to happen in near term, eventually, that's going to also drive something else, which is emerging markets. When you have a weak dollar versus other fiat currencies, and you have also a country like the US that is being forced to financial repression, lowering rates in order to afford its fiscal issues, that's not good for yields either. And so yields need to fall, the dollar needs to fall. And those are the recipes for what you tend to see in terms of appreciation of emerging markets, particularly Latin America. So I remain laser focused on the next trend that I think it's going to be Latin America and other emerging markets that are likely to receive a lot of the flows here from these changes on the macro side.
Now here's where the leverage becomes generational. Because while silver is on the verge of doubling, mining stocks aren't just playing catch-up, they're preparing to go vertical. Why? Because miners are the ultimate call option on silver. When the metal rises, miners don't just gain, they multiply. And right now, they're trading as if silver is still stuck below $20. Let's break this down. In 2025, the average all-in sustaining cost, or AISC, for silver miners is sitting between $15 and $18 per ounce. With silver at $46.71, that's not just profitable, that's record-breaking margin. Every single dollar silver climbs from here adds an estimated $100 million in free cash flow across the sector. This is what smart money is watching. This is what's driving the inflows. Take the Global X Silver Miners ETF, SIL, as the canary in the coal mine. It's up 25% year to date. That sounds decent, until you realize it's still trading at just 12 times forward earnings. Historically, SIL commands closer to 18 times. That gap is closing fast, and when it does, stocks won't just go up. They'll reprice in a way that looks more like tech stocks in a mania than anything in the metals sector. And the institutions are already moving. Q3 saw a 10% jump in inflows into SIL. They're not waiting for the headlines. They're getting in before the retail crowd wakes up. Because those who've done their homework know exactly what happened in past silver bull markets. In 2010, while silver doubled, miners tripled. In the early 2000s, some juniors went up 10 to 20 times. This is the kind of upside that only exists when the asset underneath has broken out, but the stocks on top of it haven't caught up. And this isn't just theory. Tavi Costa himself is calling for over 50% gains in miners this year alone as silver clears $50. Peter Krauth is even more aggressive, projecting that select miners could outperform the metal 2 to 1. That's 100% returns, while silver is up 50%. This is what happens when leverage meets mispricing. It's not a question of if. They just need silver to hold the line. Because once the market realizes the margins these companies are sitting on, the re-rating could be violent.
The opportunity is to invest, in my opinion, in a part of the world that has been neglected for a very long time, that hasn't received any flows from developed markets, that has also have a very resource-rich economy that is driven by resource value. And as we see the prices of commodities rise because of this hard assets bull market that we're in the beginning of, in my view, eventually that's going to drive growth. And there's nothing, if you're an investor in equity markets, there's nothing better than finding a depressed multiple, okay, very depressed multiple, historically speaking, PE ratios, price. Now, a lot of people say, all right, a very depressed PE ratio is a value trap, is a reason for why this company is trading at those levels. Okay, think from a macro standpoint, there's a bunch of companies trading as single-digit PE ratios, okay? And what we are likely to see is why companies trade at single PE ratios is because the market is reflecting low growth. Right? It's going to be no growth. Maybe they're even going to go out of business in the next few years. And that's why they have such a low, I'll give an example. Like there's remember that company Redbox where you go and rent DVDs and all that? Well, that company was trading at like 4 times earnings for a long time, after Netflix came in and so forth. And everyone was saying, well, this thing is going to go bankrupt. Well, the market was reflecting that this thing was going to go bankrupt. And so it's trading at 3-4 years. So it basically was saying, all right, this thing has maybe 3-4 years left as a business. And so, I don't think these banks, Brazilian banks, have 3-4 years left. Like, why are they trading at these such low multiples when I also have a very strong view that as we see commodity prices going up and starting flowing to the economy, which usually does, I mean, you can see all sorts of correlations of major commodities relative to Brazilian markets, Peruvian markets, Mexican markets, Argentinian markets, Bolivian markets. As we see that occurring, it's going to generate growth, right? So you're about to see suppressed multiples plus major growth. And that's nirvana for equity market investors. So I don't think people have realized this yet. And that's why the same way a few years back, I was super excited about mining and I still am, as I said just a few minutes ago. However, I think the asymmetry today from a relative standpoint, it's still, it probably is more in emerging markets.
What makes this setup even more absurd is just how mispriced these mining stocks still are. Despite silver approaching all-time highs, many producers are trading like it's 2015. This disconnect is what creates life-changing upside, not just because of leverage to silver, but because of how deeply these companies are undervalued on their own fundamentals. Look at Pan American Silver. In Q1 of 2025, their silver segment's AISC dropped to just $13.94 per ounce, a 16% year-over-year improvement. That's not just healthy, that's elite. With silver now over $46, they're minting profits with every ounce pulled out of the ground. Their stock? Up 41.8% this year. Impressive, but still nowhere near pricing in silver at $90. Or take First Majestic. Their consolidated AISC came in at $19.24 per AGEC ounce, but their Cerro Los Gatos mine? Just $13.07. That kind of margin should command tech-level multiples, but instead these companies are stuck in the penalty box, waiting for Wall Street to catch up. And when it does, these aren't 20% or 30% moves. These are 5x, 10x re-ratings if silver enters a sustained parabolic run. And it's not just about cost. It's about positioning. These miners have been preparing for this moment. They've hedged their energy costs, streamlined operations, and slashed debt. Around 30% of their operating costs are energy dependent, and by locking in lower oil prices, they've insulated themselves from one of the biggest risks in resource production. That gives them operational leverage on top of price leverage. Meanwhile, retail investors are still asleep. They're chasing meme stocks and AI narratives while the most undervalued sector in the entire market is quietly getting loaded by funds who understand what a secular breakout looks like. And when that breakout confirms, mining stocks don't climb. They detonate. So the question becomes, how long can this mispricing last? Because once silver clears and holds above $50, it's not just the metal that will reprice. It's the entire ecosystem built around it. And right now, the miners are the leverage engine ready to go.
Sure. I mean, I think the biggest thing you got to watch for is how much debt they have relative to their economy. And if you know that the U.S. government is being forced to devalue the dollar, okay, that's the key thing, right? This is why emerging markets get killed, is when the dollar is strengthening, they usually cannot really sustainably raise enough debt on their local currency markets because there's no appetite there, right? So imagine being a country that no one wants to invest in your country. And so when you're in that situation, the way you attract capital, you issue a bond in US dollar terms, so foreign denominated bond. And if the dollar goes up, your debt goes up. Well, that's not my view, right? My view is that the dollar is going to fall, right? So that's, it's the same thing as investing in a mining company, right? Why would I invest in a mining company if I have a view that gold prices will fall? I wouldn't, right? That's really not what I'm trying to do here. If I have a view that the underlying asset will go up, then think of emerging markets as almost like they produce dollars, right? It's the same thing as a mining company, right? But the difference, the difference here is that when dollar falls, it really benefits these countries. That's leverage on the dollar declining trend. And the fact that you can have that leverage at such cheap valuations, to me, is like, I don't need to bet the farm on this, right? Like, if I'm right about this, I'll give you an example, right? Because I'm from Brazil, and so I've looked at the Ibovespa index versus in dollar terms, not even in local currency terms. But if you got a movement in the dollar terms back in the early 2000s all the way to 2011, which was the last cycle, if you put a dollar there.
But here's the catalyst most investors never see coming: the slow motion implosion of the US dollar. This isn't about fear-mongering, it's about math. The twin deficits, the fiscal gap and the trade imbalance, are spiraling at a pace that guarantees dollar weakness. And when the dollar falls, silver doesn't just rise, it explodes. Let's talk numbers. The fiscal deficit for 2025 is projected at $1.8 trillion. That's not a temporary wartime spike. That's structural. Meanwhile, the trade deficit in June alone was $60.2 billion, part of an annualized gap near $800 billion. This means the U.S. is printing money to fund both its internal obligations and its external dependencies, two bleeding arteries feeding into one collapsing currency. And the market is already responding. The DXY, the dollar index, has fallen 10.8% in just the first half of 2025. That's the sharpest drop since 1973. Why does this matter? Because a weaker dollar makes hard assets more attractive. It reduces the opportunity cost of holding non-yielding stores of value like silver. And when that dynamic takes hold, it doesn't fade quietly. It triggers massive rotations into commodities. Central banks get this. They're not buying bonds. They're hoarding gold and, increasingly, silver. Private investors are following suit, not out of speculation, but necessity. Because when the foundation of the financial system, the dollar, starts to erode, the hunt for alternatives becomes survival, not strategy. Tavi Costa calls the twin deficits a major collapse catalyst for the dollar. And if he's right, we're staring down the barrel of a monetary regime shift. The last time the DXY saw a collapse of this magnitude, silver went vertical. And this time, the setup is even worse. Debt to GDP is over 130%, inflation is sticky, and interest payments are crowding out the federal budget. This isn't just bad policy. It's a feedback loop that accelerates silver's breakout. So when people ask why silver's rising now, why it's smashing through $45 and racing toward $50, the real answer is simple. The dollar is failing, and when trust in the currency evaporates, the only assets left standing are the ones you can hold in your hand. Silver just became that safe haven again.
You made $18. Okay, multiply that. All right, if you put $1 million, you made $18 million during that period. That's the most boring way of investing there. So I actually think there's plenty of ways to do much better than that. And the reason why I got into the mining industry is because I saw the same asymmetry, right? I was like, oh, I can put a few dollars and make multiples of my money. That sounds interesting. All I need is the gold price to start moving. And then the gold price starts moving. And everyone's saying, well, the mining industry is broken. This is not going to happen. And then it turns and everyone's like, oh, I told you so. No, you didn't tell me so. Like, nobody said that. Everyone was, lost their minds and thought that structurally, mining companies only bleed capital and they will never make money. And now all those people are starting to come back and say, well, should I revalue my views here? Maybe gold prices at $5,000, $6,000 do make these companies profitable. Duh. So, it's the same thing. Like, I think people are very stuck on the same idea on emerging markets, thinking that these things are led by, corrupt governments and so forth, but so is the US. And I'm not here to say that emerging markets will change structurally. Like, we're still going to have criminals running the place. We're still going to have, people like Lula running the country. I'm sorry, that's not going to change. That's not what I'm here for. Lula was running the country back in the early 2000s, exactly at that time when Ibovespa had its run of 18-fold, right? Not during the entire time, but most of it. And so, I don't know, does that really matter? Is that where you should be focused on? Is where investors usually get hung up on and the wrong stuff, So it's not a political play. It's a historic play on where the dollar is likely to go. And so, yeah, I just, it fascinates me how people get hung up on things that are not really meaningful.
And if you think it's just retail panic driving silver, think again. The smart money is already years ahead. As central banks, sovereign wealth funds, and institutional players are quietly accumulating. And what they're doing tells you everything you need to know about where silver's heading next. Because when the entities that move markets begin hedging against systemic risk, it's not a matter of if anymore. It's a countdown. Let's start with the central banks. Over the past year, they've increased their precious metals purchases by 20%. Gold has been the headline, but beneath the surface, silver is quietly riding the same wave. Why? Because silver is gold's shadow hedge with added upside. In a world where inflation is sticky and debt is unpayable, central banks are rotating out of sovereign debt and into hard assets. Silver, with its dual role as both industrial metal and monetary hedge, fits perfectly into that thesis. But it's not just governments. Hedge funds and large institutions are moving too. Q3 2025 saw a 10% jump in institutional flows into silver miner ETFs. That's not casual interest. That's strategic positioning. These are the same funds that front-ran the gold breakout in 2023, the same funds that see the dollar cracking, interest rates peaking, and real assets becoming the only way to preserve purchasing power. And then there's energy hedging, something only the big players have been executing at scale. With oil volatility threatening margins across the commodity space, miners that hedge energy costs are being quietly accumulated. It's a double bet. Rising silver prices paired with locked-in input costs. The result? Explosive cash flow and asymmetric returns. Even major banks are shifting their tone. While most retail analysts are still stuck arguing over whether $50 silver is sustainable, Morgan Stanley is projecting a 20% silver rally purely on the back of a falling dollar. That's a major shift from the institutions that once dismissed silver as a fringe play. Now it's a core macro hedge. So while the headlines are still behind, the positioning is already underway. The smart money isn't waiting for CNBC to catch up. They're buying the dips, accumulating the miners, and front-running a move that could redefine asset allocation for the next decade. Silver isn't just a trade anymore. It's a strategy. And the biggest players in the game are already moving their pieces.
Pretty early to mid. That's where we are. We saw the first wave where smart investors were in and institutional investors began to come in. And because of the size of the market, we saw a big jump. This is not ending here. This is the beginning. I feel very strong about this. Pullbacks need to be bought, in my opinion. And I would welcome them. I'm not gonna, like, the way I invest in these cycles, the way I'm planning to invest in this cycle specifically, is that I'm not trying to be a hero in time corrections. I'm trying to take advantage of corrections. So when they happen, I'm gonna buy more. And I'm hedging my position by owning as much as I can of energy companies right now, of which are breaking out as we speak. And it's very interesting because I think that that's also a very important trend taking place right now. And energy is important because it's the hedge you have on the margins of most of these companies, right? If you think about their margins is expanding drastically. First, prices are moving because people are projecting earnings. Now we're seeing realized earnings to the degree that we haven't seen in the past. And so as we see that sort of unfolding, I think as an investor, you need to think about your margins for those companies, and they usually link to energy. So think of the gold to silver ratio. The gold to oil ratio, the silver to oil ratio. Those things are very extreme right now. That's not to say that gold and silver are going to fall, but it's to say that oil needs a lot of catch up here. And that's another thing to consider.
But before we declare victory, let's address the elephant in the room. What if silver fails at $50? What if this breakout stalls, reverses, and crashes back to $40? It's a fair question, and one the bears are already shouting. But here's the thing. Even the contrarians aren't truly bearish. They're just early to the next leg. TD Securities, one of the few firms cautioning a pullback, still holds a $60 target by 2026. Their worst-case scenario? A retest of $40. But even in that view, silver would still be in a structural uptrend, and the longer-term trajectory remains intact. Why? Because the fundamentals haven't changed. The cup-and-handle breakout is still valid. The macro catalysts, twin deficits, dollar weakness, central bank buying, they don't vanish because of short-term volatility. Pullbacks aren't failures. They're setups. Every major bull run in silver has been littered with violent retracements. In 2010, silver dropped 20% in a single month, before ripping to $49.50. In 1980, it saw wild swings before breaching $50. That's how this market works. The volatility isn't a warning, it's confirmation. And here's the kicker. The deeper the pullback, the more aggressive the buy. Algorithmic traders, hedge funds, and long-term allocators are all programmed to step in at key levels. $45, $42, even $40. These aren't just random price points. They're algorithmic triggers backed by technical support, volume profiles, and decades of historical behavior. Investing Haven expects $48 by year-end and $88 by 2028 if the breakout holds. That's the roadmap. And unless you believe the entire structure, from the macro down to the micro, has suddenly reversed, a rejection at $50 isn't a collapse. It's a recalibration, a breath before the sprint. Because here's what most miss. Bull markets don't move in straight lines. They grind, they fake out, and then they surge. The key is to understand where we are in the cycle. And right now, we're not at the top. We're in the zone where disbelief turns into confirmation. So if you're hoping for lower prices to get in, be careful. The next dip could be your last chance.
No, I mean, I think I laid out the case here. I would be careful with equity market near terms, just because there's a lot of divergences that are a little bit concerning tactically speaking, right? When you have transports leading the way on the downside relative to the S&P 500, you've got a number of companies. We look at percentage companies that are not in their 70 RSI are falling, which means that the breadth of the market is falling as well, deteriorating substantially. And the equity markets remains at really high levels. And so you may see a correction here. And that correction will be welcome with a bunch of liquidity from the Treasury, because the Treasury is sitting on about almost $1 trillion of cash. But first we need the pain. And then to stop the pain, we're going to use that money. So gold is just chugging along because it knows this is all, it's all part of the problem. And so, we're probably at the early innings of a lot of things in precious metals related, and even more early innings in emerging markets. So buckle up. It's going to be a fun next 5 to 10 years.
Silver's breakout above $50 isn't a blow-off top. It's the ignition point, a signal that decades of suppression, mispricing, and structural neglect have finally given way to a full-scale revaluation. The cup and handle has triggered. The macro is aligned. The miners are still trading like silver is $20. And the dollar? It's falling apart at the seams. Every piece is in place. This is the moment the market has been building toward. Not a spike, but a supercycle. Not a headline, but a historic reset. Silver is stepping out of the shadows of gold and taking its rightful place as both a monetary hedge and industrial powerhouse in a world where trust in fiat is evaporating. And for those positioned early, the upside isn't just good, it's generational. Mining stocks are still hiding in plain sight, offering 5x, even 10x potential as capital rotates into undervalued producers with rock-bottom costs and massive operating leverage. Institutions are already moving. Central banks are accumulating. The smart money knows. This is the early innings of something much bigger. So if you're still on the sidelines, waiting for the signal, this is it. Silver just crossed the threshold. What comes next could redefine wealth for an entire generation. If you want to stay ahead of the curve, subscribe now. We'll be tracking every move of this breakout in real time. And remember, this is not financial advice. Always do your own research and speak to a qualified financial advisor before making investment decisions.